Hey guys, welcome back to Mark's Stock Review. Hope you're all doing well today. Today's video is going to be on Viomi Technology. I'm going to be talking about briefly what they do. I'm going to go over the earnings report and why the share price dropped. I'll talk about the CEO's comments, some price targets and ratings, go over some pros and cons, and a final take. And if you haven't already subscribed, feel free to do so. As you know, I keep my videos short and informative to respect your time. That said, let's get right into it. Full disclosure, I do not own this stock. However, my recent trades, since my last video, I added 2 new positions, Marvel Technologies and Xpeng. Viomi Technology is a relatively small Chinese company with a market cap of about 385 million, with a mission of redefining the future home via the Internet of Things at home. And they sell innovative Internet of Things enabled smart home products for intelligent interaction. And target consumer is China's young, modern member of the quote-unquote new middle class. Seen here are some of the wide range of products they have to offer, including smart kitchen products, smart locks, and sweeper robots with a focus on 5G. They're designed for efficiency, convenience, and enjoyment. Their business model involves 3 pillars. Number 1, Internet of Things enabled smart home products. Number 2, complementary consumable products. And number 3, factory to consumer sales strategy. Now let's take a look at why the share price dropped sharply after the earnings report was announced on November 25th. The 3 main areas of concern for me were earnings per share, gross margin, and revenue. Earnings per share was 7 cents a share, missing the estimate of 13 cents a share, down a whopping 50% year over year. Number 2, the gross margin was 17.1% compared to 22.3% Q3 of 2019. Per the CEO, this was because of a shift in their product and business mix, specifically introducing the sweeper robots and their pilot launch of their air conditioning systems. And number 3, the revenue did improve by 46.34% year over year, but still missed the estimate. And of the 3, the gross margin is the most concerning because that's a direct result of their business model of switching around their mix of products. The company is showing here improvements in operational efficiencies. That's a good thing. However, I would rather the improvements be in the general and administrative instead of cutting marketing costs, because that's what ultimately drives sales. Okay, now let's try to stay positive and look at the bright spots. Bright spot number 1 is that revenues from Internet of Things at home increased 71%. This is mostly because of the sweeper robots and air conditioning systems. This tells me they're moving in the right direction and making the right decisions, just having difficulty transitioning efficiently. Bright spot number 2 is that their products were in 4.6 million households compared to 2.6 million households a year ago. That's showing growth. And to sum up the comments on the CEO's outlook, they're really going to be focusing on their 5G Internet of Things strategy. They'll be developing tech, protocols, and frameworks, including sensor tech and smart hardware. And point number 2, they're going to be using their sweeper robots to tap into more of the export market, which currently is only 10% of their business. And to continue positive, all the price targets I found were well above the current share price of $5.50 and all had buy ratings. Moving on to the pros, the massive middle-class growth in China plus the government support of 5G in general will serve as a tailwind. Number 2, the significant growth in revenue and product distribution, in my opinion, still classifies this company as a growth company despite the earnings per share and gross margin. And number 3, I like the chart how the current share price is near the line of support. Plus, the bad news associated with the earnings report has been priced in. On to the cons. The CEO's comments and all the articles are based off of unaudited financials with a Chinese company, so that carries general risk and just needs to be considered. Number 2, the abrupt CFO resignation due to quote-unquote personal reasons, which is really just code for forced out. Not necessarily a long-term issue, but at the very least may cause some short-term disruptions to the company. And number 3, the inefficiencies which we talked about needs to be improved on by the next earnings report. My final take is the growth in the revenue and product distribution temporarily outweighs the other financials, but I would be keeping a close eye on the company and would be keeping a relatively small position until the next earnings report. That does it for this video. I hope you found it helpful. I'll have a new video out in the next couple of days with a new stock position. You guys have a great rest of your day, and I'll be talking to you soon. Take care.